Let's bring on board the management of the company. We have Sandeep Kalra, Chief Executive Officer at Persistent System, joining in with us. Thank you so much, Mr. Kalra, for joining in with us this afternoon on ET Now. I want to start by talking about your Q1 margins, right? That seems like it's missed the expectation of the street, and the street is a bit worried that there is one of that has actually supported the margin. So, do you think maybe we could see some bit of a pressure? What's your comment on that?
Sure. So let me give a bigger picture and then I'll quickly revert to this. So at a bigger picture level, the quarter one came in at $22.82 million. So this basically translates into 5.6% quarter on quarter, 16% year on year. This is the 17th sequential quarter of growth. And by for the record, this may be the highest any Indian IT services company has had in terms of sequential growth, especially in trying times like this. Now, in terms of the margin, the EBIT margin came at 14% compared to 14.5% last quarter. And we had very clearly set the tone last quarter itself, saying for the full year, we are looking at a flat margin for FY25 compared to FY24. So we had said we'll grow at a decent curve and we will basically deliver the margin, which is roughly about 14.5% for the full year. In any business like ours, when you win larger deals, which are fueling our growth, so 5.6% quarter on quarter may be the among the best growth, if not the best in our industry for the quarter. Now, obviously, this is basically ramping up the deals that we have won, certain of which are vendor consolidation deals, certain of which are deals which are involving transition from on-site to offshore, where we need to deploy initially contractors on-site because we have to ramp up faster. That comes in at lower margin. So that is what is causing a little bit of margin turbulence. The other things are when you look at us, when we start a financial year, that is the time we make any adjustments, whether it is with respect to giving newer ESOPs, doing other employee related benefits. So there are puts and takes. Now, if one just starts to look at only the puts and not the optimizations, you can infer whatever you want to sitting outside the company. As the management team of the company, all we are saying is we'll grow at the industry leading, we'll deliver nearly the same margins as the last year. The quarter four exit will be at a better margin because we would have optimized our operations. We would have optimized the larger deal wins, offshored some, and hence there is no cause for worry. So that's where our commentary is.
Right, Mr. Kalra wanted to prod more on the margins front. Do you think that it has bottomed out? And are you set for a 200 to 300 basis points improvement over the medium term?
Yeah, so two parts to it. Historically, July quarter is where we give the salary increases to people. In our industry, today there's a mixed bag of people not giving salary increases, deferring it out indefinitely, versus us, we have given the salary increase starting July. So the quarter on quarter, our endeavor is to come as close to the 14% mark that we have today. And by the time we exit the year, our run rate should be such that we should be for the year around 14.5% and overall much better than 14.5% as we exit. So that would lead to the second part of what you said, the 200 to 300 basis point improvement over the next couple of years, because the exit run rate would be better. And we stand by that. Look, to optimize margins is a much easier task. To bring growth in any company, in any sector is a much harder task. We have delivered the harder task. We can optimize and we have enough margin levers, whether it is offshoring on the larger deals that we have done, whether it is optimizing our own operations, whether it is defraying our cost over a larger revenue run rate, which is obviously panning out. So we want to be among the best run companies, revenue growth, profitability, and at times in bad economy, it is a time to take market share from our peers, and that's what we have done. So we remain confident to your point that we will deliver a good mix of revenue growth, profitability, set the base for the 200, 300 basis points improvement that we have been saying over the next 2 years.
Right. Also, just in terms of margins a bit more, so margins might dip below 14% in Q2. This will be mainly due to the wage hike, etc. Or what are the other factors that would come into play here?
So look, that is the thing that happens as a seasonality in every IT services company. When the quarter you give salary increases, your margin goes down a little bit. So yes, it is predictable. You can look at our historical performance in the salary increase quarter, not only for us, but for any other company. So yeah, there may be a small weakness in the quarter, which is the current quarter from a margin perspective, and then we recoup. That's been the traditional trend. And all we are saying is we put enough discipline in place so that the hit, whatever we take on account of salary increases, and yes, we want to give salary increases to our employees. We don't want to defer it. And we will recoup it, 14.5% EBIT, and then go up from there.
Right, Mr. Kalra, let's come to the positive then. The revenue growth. Was there any one-offs? Is this 5.7% 5% plus sustainable going ahead?
So there was no one-off that was there. It is a secular growth in different industry verticals. It is within, let's say, our healthcare life sciences part, which has grown the most. It is multiple deals in multiple customers, followed by multiple larger deals in banking financial services. Our pipeline looks good. The order book has been fairly decent. So from that perspective, it is a secular growth. It is not based on any one times. And look, we don't give forward-looking guidance, but if you convert the bookings that we have done into a revenue conversion trend that we have been doing, we have delivered 17 sequential quarters of growth, which is the highest sequential number of quarters any Indian IT services company has delivered in the public space. So from that perspective, we are happy where we are. We are seeing good, traction in terms of revenue growth. How much it will be, we'll let the quarter span by.
Right. Also, what about the demand on ground? Any green shoots specifically coming in from the BFSI segment or the North America side?
So far, the demand environment remains to be the same. There is green shoots in terms of little optimism of rate cuts, and the rate cuts impact the financial services sector, the biggest among various sectors. Sectors like healthcare, life sciences are a little bit more robust because the demand in healthcare is more, secular. So far, our deal wins are not based on the hopes of market improving. The wins that we have had are on the back of investments we have done over the last 18 months in building a platform called SASVA, which is our AI-led platform for service delivery, which is gaining us traction, helping us win more. So all the investments that we have been doing in technologies like AI and Gen AI, they are leading to our growth. Market environment is the same. Should it improve, that will also help us positively.
All right, Mr. Kalra, thank you so much for joining us. We will let you go on that note.
If you like this video, then like, share and subscribe to ET Now.